RPM International Inc. delivered record fourth quarter results, beating their prior year numbers across the board. If you are a retail investor holding this stock, the headline numbers you need to know right out of the gate for Q4 2026 are record revenue of $2.23 billion, which is up 7.2% year over year, and record adjusted earnings per share of $1.89, up 9.9%.
Right, and the forward-looking guidance they just dropped is equally aggressive. For the first quarter of fiscal 2027, they're projecting sales and adjusted EBITDA to both grow in the mid-single-digit range.
Wow, okay.
Yeah, and looking at the full year for fiscal 2027, management is targeting 3 to 7% sales growth and 5 to 10% adjusted EBITDA growth.
So, on the surface, it's a beat, it's a record, and the guidance looks incredibly solid. Our mission today for this deep dive is to completely unpack this earnings report for you. We are going to look under the hood at the segment performance, the margin drivers, what management actually said in their commentary, and most importantly, the notable risks hiding inside this full year in Q4 report so that you have the crucial takeaways.
Because there are definitely some hidden risks in there.
Oh, absolutely. But let's start with the margin expansion story. In an environment where, practically every company in the materials sector is complaining about inflation, RPM's Q4 adjusted EBIT hit a record $338.6 million.
Which is huge.
Right. That's up 7.7%. And their adjusted EBIT margin actually expanded by 10 basis points to 15.2%.
To put that in historical context for you, this marks the 16th time in the last 18 quarters that RPM has generated record consolidated adjusted EBIT.
Wait, 16 out of 18 quarters?
Yeah, 16 out of 18. And generating that kind of margin expansion in this macro environment, well, it requires a massive internal mechanism. For RPM, that engine is their MAP program, which stands for the Margin Achievement Plan.
Right, and the sources note they currently have 620 trained greenbelts actively managing a $30 million pipeline of projects.
Yeah, and they are already transitioning to what they call MAP 3.0, where they previously announced $75 million in SG&A-focused savings for fiscal 2027 that they claim is fully on track.
I read that and immediately thought about it like a corporate immune system.
Oh, that's a good way to look at it.
You have these 620 green belts acting like white blood cells, constantly circulating through the company, hunting down and eliminating inefficiencies wherever they find them.
Right. They're just aggressively looking for waste.
But look, I have to push back on the corporate jargon here. Whenever management teams start tossing around terms like margin achievement plan or, green belts, it usually just translates to firing middle managers and cutting the travel budget to make the quarter look good.
Oh, for sure.
So I have to ask, are we seeing a genuine structural improvement to their operating leverage here, or is this just standard slash and burn cost cutting?
That skepticism is entirely warranted because, frankly, we see short-term budget slashing all the time. But looking at the mechanics of this report, this is actually structural.
Okay, how so?
Well, when a company slashes budgets just to hit an earnings target, you usually see the wheels start to fall off in other areas, like production delays, quality issues, or a spike in customer service complaints.
Right, the cracks start to show.
Exactly, and we aren't seeing that here. What these green belts are doing is fundamentally rewiring how the factory floor and the supply chain operate. It's really about optimizing throughput.
Meaning they are just getting more product out of the exact same physical factories.
Yes, and that creates a massive advantage in fixed cost utilization. Think about it this way. The cost to keep a massive chemical plant running stays relatively flat.
Like the electricity and equipment leases.
Right. The electricity, the base labor, all of that costs the same, whether you reduce 10,000 buckets of sealant or 12,000 buckets.
That makes sense.
So by optimizing the supply chain and eliminating manufacturing bottlenecks, they are pushing way more volume through that same fixed cost base.
So every incremental bucket they sell drops significantly more profit directly to the bottom line.
Exactly. That structural improvement is really the only reason they were able to expand margins this quarter while simultaneously absorbing higher healthcare expenses, insurance costs, and all that lingering raw material inflation.
Well, the efficiency engine isn't clearly working, but it only works if someone is actually buying all those extra buckets of sealant.
Very true.
Which brings us to the segment breakdown. And this reveals a tale of two very different consumer environments. It is a really stark contrast between commercial infrastructure and everyday retail.
Yeah, the commercial side of the business is just booming. If we look at the Construction Products Group, or CPG, sales jumped 8.8% to $904.2 million.
That's a solid jump.
It is, but the standout metric is the margin jump. They saw a 100 basis point expansion, bringing their adjusted EBIT margin to 19.4% in that segment alone.
100 basis point expansion when raw materials are still expensive is huge. What on earth are they selling that's driving that kind of pricing power?
It is heavily tied to the current infrastructure and technology build-out.
Yeah.
We are talking about highly specialized concrete admixtures, roofing restoration systems, and labor-saving wall systems designed for high-performance buildings.
Okay.
And a massive driver management called out specifically is data centers.
Oh, wow. Which makes perfect sense when you think about the artificial intelligence boom.
Right.
You can't just throw up a basic warehouse for an AI data center. The heat generated by those servers requires incredibly specialized, high-performance concrete, advanced cooling structures, specialized roofing.
Absolutely.
They were essentially selling the picks and shovels for the AI gold rush.
And you see that exact same momentum spilling over into their Performance Coatings Group, or PCG. Sales there were up 5.0% to $562.8 million.
Also driven by data centers.
A big part of it, yes. A major driver was fireproofing systems for those same data centers, alongside food coatings and ingredients. Their adjusted EBIT in this segment grew 10.6%.
Wow, double digits.
Yeah, and what makes that double-digit profit growth so impressive for you as a retail investor to note is that they achieved it while eating a very specific $3.2 million bad debt expense from a customer bankruptcy.
Okay, that is a great indicator of business resilience. I mean, if you can take a surprise $3 million bankruptcy write-off straight to the chin and still grow your segment profits by over 10%, your underlying pricing power is just phenomenal.
It really is.
But then we get to the consumer group. This is the Rust-Oleum, the DAP, all those DIY brands you see in the hardware store.
Right, the retail side.
On paper, the headline number looks fine. Sales were up 7.0% to $764.8 million. But when you actually unpack the mechanics of that growth, the narrative completely flips.
This is a totally different story.
Yeah, that 7% growth was driven almost entirely by M&A, mergers and acquisitions, which added 7.2%, plus a few price hikes. The organic sales, meaning the actual volume of everyday products sold to consumers from their existing business, declined by 0.8%.
Yeah, the everyday homeowner is simply doing fewer DIY projects right now. You can see the immediate impact of that volume decline on the bottom line.
Because they don't have that fixed cost advantage we talked about earlier.
Exactly. Unlike the commercial segments that are expanding, the consumer group's margins actually dropped by 70 basis points. Furthermore, they had to take a $9.7 million non-cash impairment charge related to their color group.
And that was because of persistent softness in the OEM markets, right? The original equipment manufacturer market.
Yeah, exactly.
And taking a nearly $10 million impairment charge means they essentially had to admit that the assets in that color group division are no longer worth what they previously stated on the balance sheet.
Right, because the future cash flows just aren't going to be there to justify the valuation.
Look, I analyzed these three segments, and it feels like the consumer segment is a leaky boat. Everyday volumes are dropping, so management is aggressively patching the holes with M&A and price hikes just to make the total revenue number look bigger.
That's a great analogy.
I mean, if you buy a new boat and tie it to your sinking one, your total fleet looks bigger on paper, but you're still taking on water. Meanwhile, the commercial segments, CPG and PCG, are cruising by on a twin-engine speedboat fueled by this massive data center and infrastructure boom.
The leaky boat analogy is literally the best way to understand how M&A can mask organic decline in earnings reports. When a company buys another business, they get to instantly add all of that new business's revenue to their own top line.
Making it look like a huge win.
Right. For the retail investor just skimming a press release, it looks like the company's growing rapidly.
Right.
But as you pointed out, when you strip away that purchased revenue, the core consumer demand is actually shrinking. And that reduced fixed cost absorption from lower consumer volumes is directly hurting their margins. It's the exact opposite of the operational leverage they're enjoying in the commercial segments.
Well, if the U.S. consumer is tightening their belt, that brings up a vital question about where RPM is finding enough demand to offset that drag. I mean, they are not just a North American story.
Not at all. The geographic breakdown provides some really compelling data points that show just how global this infrastructure boom really is.
What are the numbers there?
Well, North America still makes up 77% of their total sales, and it grew a solid 5.1%. But the emerging markets absolutely exploded. Latin America sales were up 18.9%, and the Asia-Pacific region was up a staggering 39.4%.
Wait, almost 40% growth in APAC?
Yeah, nearly 40%.
That tells you the heavy infrastructure and data center build-out isn't just an American phenomenon. It's a global capital expenditure cycle, and RPM is clearly positioned to capture it. But let's bring this back to the retail investor listening right now. Growth and operational efficiency are great, but how does this translate to the actual cash hitting the bank account and, shareholder value?
It translates into very real liquidity. Their cash provided by operating activities for fiscal 2026 was $898.7 million.
Nearly 900 million.
Yeah, and to put that in perspective, that is the second highest operating cash flow in the entire history of the company.
Wow, which means all that theoretical MEP efficiency we talked about earlier isn't just an accounting trick. It's actually converting working capital into hard cash.
Exactly, and management is deploying that cash aggressively.
Mm-hmm.
They returned $349.2 million to shareholders this year via dividends and repurchases.
Nice.
But more importantly, the board of directors just authorized a massive $700 million increase to the share repurchase program.
So for you as the investor, a $700 million buyback authorization really does two things. First, it's a serious signal of confidence from the board that they believe the stock is undervalued. And second, by taking those shares out of circulation, every single share you currently own becomes a slightly larger slice of the overall pie, which artificially boosts the earnings per share going forward.
It absolutely does.
But speaking of artificial boost, there is a highly technical accounting shift in this report that we definitely need to dissect.
Oh yeah, the metric change.
Right. Starting in fiscal 2027, management announced they are changing their primary profit measure from adjusted EBIT, which is earnings before interest and taxes, to adjusted EBITDA, which adds depreciation and amortization back into the mix.
Right, and they claim this is to facilitate peer comparisons during periods of acquisition activity.
I can hear the alarm bells going off in your head because my guard immediately goes up when a company changes how they measure their own success.
It's always a red flag at first glance.
Exactly. I have to ask, is shifting to EBITDA just a convenient way for management to make the profit numbers look better? We just established that the consumer segment is relying heavily on M&A to mask declining organic sales.
Yeah, they are.
And when you buy companies, you take on massive depreciation and amortization costs. Are they just trying to hide the cost of these acquisitions by stripping those expenses out of their new favorite metric?
It is the absolute right question to ask. Anytime a management team moves the goalpost on how they report profitability, investors need to scrutinize the motivation.
Right. You have to.
However, if we look at the mechanics of RPM's specific business model, there is a legitimate financial logic here. RPM is a roll-up company. A significant part of their growth strategy involves constantly acquiring smaller businesses, specialized coating brands, and regional manufacturers.
Yeah.
And when you do that, you inherit an incredibly complex accounting situation.
Because you aren't just buying the physical factory. You are buying the brand name, the customer lists, the patents.
Right. In accounting, those are intangible assets, and you are required to amortize them, meaning you have to deduct a portion of their value from your earnings every single year, even though you aren't actually writing a check for that expense.
So it's just a paper loss,
Yeah.
essentially.
Exactly. It is a non-cash accounting artifact.
Right.
As RPM buys more and more companies, their amortization expense skyrockets, which artificially depresses their net income and their EBIT on paper.
Okay, so it makes the business look far less profitable than the actual cash it's generating on a day-to-day basis.
Precisely. By shifting to EBITDA, they strip out those non-cash amortization artifacts. It actually provides a cleaner look at pure day-to-day operating performance across their portfolio, regardless of when they bought a specific brand or factory.
I see.
It also makes it much easier for Wall Street analysts to compare RPM to other highly acquisitive companies in the materials sector because, everyone's M&A schedule is totally different.
Look, that makes logical sense, but I still think retail investors need to be careful here. EBITDA can be a very seductive metric because it always looks higher than net income.
Oh, without a doubt.
But you can't pay dividends with EBITDA, and you can't fund new factories with EBITDA. You can only do that with actual cash.
That is the critical takeaway. EBITDA is a useful operational tool, but cash flow is the ultimate truth teller. You must always cross-reference their new EBITDA numbers with the cash provided by operating activities line on the cash flow statement.
Just to ensure real money is actually entering the business.
Exactly. Fortunately for RPM, as we just noted, they just posted nearly $900 million in operating cash, so they do have the liquidity to back up the accounting change for now.
But before we declare this quarter a flawless victory, we have to talk about the risks. The cash flow is great today, but management was very clear about the headwinds they're facing as they look toward fiscal 2027.
Yeah, the forward-looking commentary was incredibly cautious. They explicitly called out economic uncertainty and inflationary pressures.
Which is pretty standard, but they got specific, right?
Very specific. They pointed to geopolitical events in the Middle East causing disruptions that are directly impacting supply chains and raw material costs.
And they gave us really concerning numbers on that inflation curve. They are expecting raw material inflation to hit 5 to 6% in Q1, and then they expect it to accelerate to 6 to 8% in Q2.
Yeah.
That is a steep curve for a company that relies heavily on petroleum-based chemicals and resins.
The critical detail here is how they plan to handle that inflation spike. For Q1, they expect their pricing increases versus those inflation dollars to be merely neutral.
Let's break down what neutral actually means in this context, because it's vital.
It means they are raising prices just enough to cover the absolute dollar increase of the raw materials, but they are not preserving their overall margin percentage.
Oh, I see.
Right, so if it costs them an extra dollar to make a bucket of paint, they are only raising the price by $1. They explicitly stated they only expect to recover their gross margin percentage later in fiscal 2027.
And that heavily assumes raw material costs actually stabilize in the back half of the year.
Exactly. Plus, they noted they are facing startup costs at new shared facilities, which will act as an additional drag on earnings in the near term.
When I look at those risk factors combined, it tells me management is walking a very precarious tightrope right now. Let's look at that 6 to 8% raw material spike coming in Q2.
It's a big jump.
They can't just keep raising prices indefinitely to cover that without eventually crushing demand. We just spent a lot of time discussing how the DIY consumer segment is a leaky boat, right, with organic volumes already shrinking by 0.8% this quarter.
Yeah.
The elasticity of demand is a real problem here. I mean, if inflation hits 8% and you jack up the price of a can of Rust-Oleum by another 8% at the hardware store just to stay neutral, you risk the everyday consumer just walking away from the project entirely.
You've identified the primary friction point for fiscal 2027 right there.
Mm-hmm.
The commercial segments have incredibly high pricing power. If you are building a billion-dollar data center, the roofing and fireproofing are mandatory.
Right. You will absorb an 8% price hike because you literally have no choice.
Exactly. Okay. But the consumer group is heavily reliant on discretionary spending. If a homeowner feels squeezed by inflation at the grocery store, repainting the patio furniture becomes entirely optional.
Totally.
So RPM's strategy of patching consumer volume declines with aggressive price hikes will eventually hit a ceiling. Monitoring whether the consumer completely taps out in Q2 is the biggest risk factor for anyone holding this stock.
It is absolutely the metric to watch over the next 6 months. Now, to close out our deep dive today, I want to pivot and leave you with a forward-looking strategic angle that wasn't the main focus of the headline numbers, but is really vital for understanding RPM's long-term competitive play.
Yeah, let's talk about it.
If you look closely at the sources, management is heavily emphasizing what they call system sales.
Right. They are aggressively promoting turnkey solutions for the commercial side of the business.
Rather than just selling a developer a single bucket of industrial sealant, they want to sell the building owner a complete Tremco roof system, integrated with a Stonhard floor system, all wrapped inside Dryvit exterior walls.
All guaranteed to work perfectly together.
Exactly, all under one warranty, and most importantly, all from one vendor. Consider this: as commercial real estate developers become more and more exhausted by labor shortages, fragmented supply chains, and just complex project management, could RPM's ultimate economic moat in the coming years simply be procurement simplicity?
That is a really fascinating angle. We spend so much time analyzing the proprietary chemical formulas of the coatings themselves.
Right.
But perhaps their biggest competitive advantage will simply be making a general contractor's life easier. If they can bundle the entire exterior envelope of a building into a single purchase order, they remove a massive amount of friction for the buyer.
And it locks the customer into the RPM ecosystem. I mean, if you own the entire exterior of a data center from top to bottom, the switching costs for that developer to try and piece together a dozen different competitors for their next project become incredibly high.
Yep.
It is a brilliant strategy for capturing recurring revenue.
It is definitely something every investor should keep in mind as we watch this global infrastructure boom continue to play out over the next few years.
That is our deep dive on RPM International's Q4 results. Make sure you hit follow on the show so you don't miss our daily no-fluff earnings coverage. We'll see you next time.